Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Welcome to the Wealth Without Wall Street podcast. This is Joey, the Italian Stallion Murray. I'm joined by my co-host, Russ, the Idea Guy Morgan. And Russ, we've got a very touchy subject today. What if someone tells you to cancel your whole life insurance policy?
Please run away.
We're going to answer that question today.
Just say no. Was that like the Barbara Bush like thing that they ran way back when? Just say no.
That's what us 90s
kids
had.
Yeah, us 90 kids know
80s
that.
and 90s.
Just say no. But that's not uncommon. We've heard that before, right? I can't tell you how many people I've met since we've been doing this who come up to me and are just like, man, I'm so excited. We're using this insurance stuff in order to grow our life, grow our business, create stress-free, finances for us. But did you know that I actually had one of these insurance policies way back when? Either a parent gave it to me or maybe I did it right out of college with a buddy. And I canceled that thing. Yeah, because I started reading and listening to all these yahoos telling me that life insurance was such a bad idea. And I didn't know any better, so I just canceled it. I did away with it.
Oh, that's the heartbreaker when you hear that story.
It is.
I've heard it so many times. But at the end of the day, Russ, don't we just want to know that we're doing the right thing? We don't want to make a mistake.
Yeah, internally, we're always questioning, am I doing the right thing? Especially when we work so hard in our jobs, and it's hard for us to take time to really look at our finances. And so then we assume that everybody else who's giving us advice are experts.
But let's yeah, that's not the case. Think about it this way, though. The people around you that may have never even done anything with infinite banking, learned about life insurance, what are they passing on to you?
Hey, they're passing along ideas and opinions.
In its very small ideas. These are common ideas that they've maybe heard just in passing by. They have not experienced this kind of stuff.
Well, and that's what you just explained is something I've mentioned to people before. It's like, you've heard me talk on here about my wife being a dentist. And by the way, I have so many dental clients. I've done lots of research. I've gone to CE with my wife's office. For someone who doesn't know me, if I were to sit down and start talking to them, they could confuse me as being a dentist if we got deep into that discussion because I can talk the lingo. I know enough. But do you think I understand what it's like to actually put a crown in someone's mouth?
I wouldn't let you do it.
No,
I'm just going to say that.
Of course I don't. But just, that knowledge, or I'm using my air quotes here, is not understanding. And there is differences. And we want to dive into that today because sometimes we're taught from other people who are trying to pass along their own opinions, probably mostly unfounded because they haven't had any understanding, real experience with. And what are they doing with their day jobs? They're not experts in the financial field. They're doing whatever they do for a living. And they're telling us what we've done is wrong. And I want to dive through that because I think that's a big mistake for us to start second guessing what we went with on the first part.
Well, let's talk about some of those common objections, right? Some of the things that people are, again, uninformed, ill-informed, whatever you want to call them, are going to throw at you that maybe you start to question, right? So one of the common things is, man, you could get way cheaper insurance. Cheaper insurance, right?
Well, because they're appealing to our Walmart shopper needs, right?
Yeah.
Who doesn't want to get something for less money?
I don't want to lose money on the deal, right?
No, of course I don't want to lose money on the deal, Jim Gaffigan.
But cheaper insurance assumes that you're actually paying more for whole life insurance than you are for term insurance. But we've talked about this maybe before. How many term life insurance policies ever pay out a death claim?
Well, it's like less than 2%, right? But how many of our clients are buying these insurance policies for a death benefit?
Very few.
versus buying them for the actual cash accumulation and usage.
Right. That's the primary function.
I mean, when we sell millions and millions of dollars of cash value every single year to people who really don't need insurance and don't want insurance, and we would all go to the insurance company and say, "Okay, I'd like to put in $500,000 a year and have a zero death benefit, please."
right.
We
If
would.
we could, we would.
If the insurance company would give it to us, we would do it under the way that we all understand how life insurance works because of all the tax benefits that and liquidity benefits and other things we're going to get into a little bit later. That's what we're looking for. But most people who don't understand anything about this, they always come at it going, man, you just pay way too much for life insurance.
Right. They're thinking specifically in light of protection. And if I can get $1 million term policy for $1,000 a year versus $1 million of death benefit in a whole life policy that's maybe $15,000 a year, whatever the number is, oh my gosh, I'm losing all that money.
Well, go back and watch our Dave Ramsey is Wrong video, or go listen to our Dave Ramsey is Wrong podcast, because we broke down, because that's a Ramsey saying, right, on what you just went through. But what I would always kind of point to, if somebody comes to you and says, you're paying way too much for life insurance, then you automatically can discount everything they say from that point forward, because you know they don't know what we're talking about.
Right. This is probably a non-issue, but I'm just going to throw it out anyway. If I put in less money than what my policy produces in terms of cash, which it will, guaranteed, and it then pays me and my heirs a death claim above and beyond what I've ever put in it by tons and tons of money, how much did it actually cost me? What was the cost of that?
Well, I'm going to break that down for everybody else who just got glazed over. I know what you're talking about, Stallion, but I think you just went way too fast. So let's just say you put in $2 million in your life insurance policy over the next 50 years, and you took out $6 million in income from that $2 million you put in, and it left another $2 million death benefit to the Italian stallion heirs. How much did it cost you to put in $2 million and for your family to take out $8 million? It costs nothing.
Yeah, I'm not great at math, but I'm going to go ahead and say zero.
Yes. So, but at the end of the day, here's just one of those really quick ones. When you hear you're paying too much for insurance, just go ahead and discount it, because you know what they're talking about is they're talking about life insurance. We're talking about cash value. I mean, the old saying is some people buy a drill bit, we're buying a hole, right? We're literally want the result of what we're paying for, not the actual thing itself.
Okay, now we've broken that one down. The second common objection is, oh my gosh, you could get such a better return in fill in the blank.
Compared to what?
Exactly. Yeah, we're not talking about an investment in life insurance, are we?
Well, I mean, here's the thing is that's again, I mean, we're giving you the cliche question marks, the things that people throw at you and think, oh, I got you now. If I didn't get you on the insurance was too expensive, I'm going to get you on the return, because we all know life insurance only produces 3, 4, 5% returns. And then I always look at them and I go, that's really interesting. So you're predisposing that I cannot invest from my life insurance contract.
Great point. Explain what you mean by that.
Well, if someone's telling you could get a better return, they're assuming that you can only do one or the other. But yet we all know, I mean, you've listened to us talk about the podcast on Opportunities Find Cash, right? How we use our life insurance policies to actually invest in things. And why do we do that?
Because it enhances the investment that we're making.
Yeah, because the money had to come from somewhere. I could use cash that earns zero, or I can lose a life insurance policy that earns interest. Let's use logic here and say, if I'm going to invest from cash that earns zero, I could invest from a life insurance policy that continues to earn interest, even if I borrow against it. Which one will have more money?
Right. Give me both.
Yeah, logic
why do I have to
tells me.
choose? Right.
So again, we're kind of breaking down what are the most cliche responses to you should get rid of your life insurance policy. But this is what we're dealing with, guys. It's amazing to me when we're to be made to feel bad that we've made these decisions, when the reality is the people who are talking to us about this, they don't understand this at all.
Well, think about it. This is an uncommon strategy. If it was very common, everybody around you would be talking about it. But you kind of can feel like I'm out on an island. In fact, how many people are a part of our Wealth Council, that's our closed Facebook group just for clients, are getting in there and saying, wow, I felt like I was the only one until I came to this group.
Well, and here's the thing is that's okay to be uncommon, by the way. I mean, do you want to be like all the people out there that are broke, that are searching for answers who know nothing? Or do you want to be like the select few who actually understand this stuff? Because here's the thing. The wealthy of individuals, the largest of corporations, they understand this.
Right. They're doing this at a very, very high rate. And they're doing it in a quiet manner. Right? Like we've talked about in previous podcasts, the biggest banks in the world, in fact, the one I used to work for, $18 billion in cash value life insurance, which dwarfs how much they carry in real estate at $10 billion. And me coming from that world, I thought banks had way more in real estate than they would ever have in life insurance.
Well, you would assume so, right? Because, I mean, of course, they're putting the bank branches at the best corners in any city that they're in.
Right. But even talk a little bit about this, Russ. I know recently you were at a family office, and, for those who don't know, a family office is going to be a very select number of families are entrusting their funds to this group to manage it, to give them advice at a very, very high level. This is not, very few families will even qualify for something like this.
Yeah, typically a family office is not going to take somebody that has less than, say, 10, 15, $20 million. And they're going to handle all the estate planning, the accounting, everything that you can think of. They do it for very elite, affluent families.
And so you're meeting with one of those offices.
Yeah, so I had a couple clients who are a part of this and have hired this group, and they're looking at putting in large amounts of money into life insurance. And the family office had some questions, right? They wanted to, wonder why we were looking at this amount. And so as we sat down and broke down, and I'm sitting there with somebody who manages $2 billion for this group of, say, 45 families, and he's asking me questions. He wasn't 100%, in the know of this, which was a little bit shocking to me. I thought maybe you'd have a little more insight. Now, the other guy, the attorney that was in there, he had insight. He knew. He was like, well, yeah, we have several of our clients that have these policies, and we're helping them, do different things with them. But as we went through this process and we broke down all the different things as it relates to the liquidity, the creditor proof, the tax-free return that these insurance policies produce, the income that it can produce for these guys when they're in retirement, and then the death benefit to their estate. After it was all said and done, an hour and a half we've met with them, the guy looks to my client and tells him after the fact, look, I don't have anything that I could put you in with that same sort of safety and guarantees and even match this even anywhere close. So, of course, they wanted to try to limit how much money you wanted to put in there because they want to keep more of the money under their asset management portfolio. But at the end of the day, they signed off on this thing. And that helps me really, when I'm talking to somebody and they're questioning whether or not they should be putting in $50,000, $100,000, $250,000 a year, and we got people who are putting in millions of dollars a year. It's kind of like, this is not something that you should feel bad about. You just need to understand more about what you have, and then also realize that other people don't understand what you have.
But let me just jump in from a personal aspect. So I remember early on me meeting with you, and I probably wore you out because about every three...
Did you just say probably, Stallion?
Yeah. Okay. It definitely happened.
I had a meeting over at that WF office.
But I remember having to come back to you on a regular occurrence and say, okay, remind me again why I wouldn't just pay cash over here and why I would need to use my policy for this, let's say renovation on my house or this vacation or whatever it was that I was needing at that time. So I don't want to make this sound trivial. Like if you are thinking about this and questioning and wondering, it's totally normal because there is nothing but noise around you all the time.
People are coming after us constantly. And what does everybody else want us to do? They want us to do exactly what they're doing. You know, I mean, the old adage of the crabs in the barrel. You've heard about this. You get crabs in a barrel.
Oh, yeah.
And one tries to climb out. What does the other crabs do?
Oh, they pull them back.
They pull them back. And that's really, everybody wants you to stay in the barrel with them. They don't want you to crawl out and be exploring the world at a different level. And we know that as entrepreneurs. People look at us like, oh, I could never leave the safety of my job and to go out and pursue this on my own. Like, yeah, I know we're different. We're made different. We're idea people. We're going to pursue a different level of satisfaction in our life. And that's why it's okay for us to be different in the way we put money away. But at the end of the day, know that we're doing the right thing. But I will go back to something you said a second ago. That it's crucial to this is that we need to be in community. We need to have other people that are around us, that are doing this, that are similar to us. And that's a big key point for the handful of times. I mean, here's the thing. We've been doing this since 2009. And I can count on one hand, maybe 6 or 7 people potentially in the, 10 years almost that we've been doing this that have decided I'm not going to do this and have walked away from it. So that's like 99.8% of the people that we work with are still working with us and still doing this. So there's a few people that just for whatever reason, they get pulled back into the bucket. Right?
That's right. That's right.
And they've walked away. But here's one of the biggest things I recognize in those 6 or 7 people, and unfortunately, you know, I'm just one of those. I'm the shepherd, you know, that wants to go get the one lost sheep, you know, the 99 that are sitting here. I'll leave the 99 in the field to go catch the one, and I'm always frustrated when that one gets away. But you know, the commonality between all of those people, they were not in community. They were not engaging in a podcast. They were not engaging in videos. They're not engaging in our wealth council. They're not listening to other people and learning from people like themselves. They ultimately decided to get back in the bucket.
Right. And so let's be really practical here, okay? If you find yourself, number one, being in this kind of a position where you're starting to question, someone's gotten in your ear and you start really thinking about it, let's talk about what is a format that we should be thinking about. What could we do instead of this? Right? What questions should we be asking ourselves is, okay, if I didn't do this premium into this life insurance, this deposit, so to speak, into my life insurance this year, where else could I put that money? And this is because it's always as compared to what? Right? That's how we always break down objectively how to make a decision. So the first thing we would think about is control. What other thing or what other vehicle could I be putting my money in, my cash, that I could control the outcome of that or the access and use and liquidity of it?
Okay, so break that down. So we have a mutual life insurance policy in which we're putting money into, and then we're going to put it into something else. So we're going to just use Willie Wall Street here. I'm going to go put money into a stock and mutual fund, right?
Right into Willie's pocket.
All right. So somebody like looking out there says, well, hey, you know, if I go put it in Apple, that's a huge, you know, $1 trillion corporation, or I go put it into, you know, XYZ, you know, life insurance company that's probably close to $1 trillion operation, then, you know, how do I have control over what happens there? Give me an example, Joey, of how I have more control within a life insurance policy than I do within just some company.
Okay, well, the question would be, how much of that company do you own? Of Apple, how much do you own?
A fraction.
Are you sitting in the cubicle next to the owner's office? At Apple? No.
No, I have an iPhone.
You're pretty far removed from the guy that owns Apple, right?
Sure.
Or the company itself. But when it comes to the mutual insurance company, you are a part owner of that entity right when you buy your first premium, your first policy. So you are that close. In fact, I get a shareholder, thing in the mail all the time. Vote on these. Vote on this. Vote on this. Vote on this.
All right. Well, I'm gonna challenge you on that though. But if I own Apple, I mean, again, I don't own stocks, so it's been a long time. But my assumption is they're going to send me a shareholder notice, a proxy vote potentially. I don't know if they do or not. Depends on how I own it, right? Maybe it goes to that money babysitter, and I never get to see it. But I don't get. I could potentially have a vote, but what's my? If I got $50,000 in Apple and $50,000 in life insurance policy, I mean, are really impacting the result of the company?
No, but I would think about it more from the standpoint of what rights do I have in that ownership? Like, does the company, in this case, the life insurance company, they have given me the right to borrow against that policy at any time for any reason, no questions asked.
So there's a contract.
That's right.
That's the difference. I'm just testing you here, Stallion. I mean, everybody out there is listening. They didn't know the answer either, and it's good. I mean, it's okay for the teacher to keep teaching, right? A little bit here. I like this from time to time.
Sensei.
But no, what you have is a contract. That's the major difference. You have a contract that says exactly, expressly what the insurance company's rights or what they have to do in relationship to your ownership. When you buy a stock, well, you're not getting any sort of contract. You're not getting any sort of rights in which they're going to deliver to you guarantees. None of that's going to happen. They're going to dictate to you exactly what's going to happen. Now, if you have 51% ownership, now you have some ability to make some changes.
You got some work to do to get there.
But in a life insurance policy, you have a contract with this insurance company, a unilateral contract, meaning that they're the ones that have to maintain it, not both of you. Then you're in a position of control. And the ownership dividends have to, by that contract, are spelled out to come back to you. Have to give you a loan against that cash value because it's in the contract. Have to guarantee grow because it's in the contract. And by the way, that company was probably started in the 1850s. And an example in Apple's situation was not born in the 1980s.
That's right.
I mean, we're talking about two different things.
Yeah. So you hit on another thing, and there was something about safety. Okay.
Yeah.
So let's talk about that. What other thing could I put in money in that would be safer than my life insurance contract?
I don't know. I mean, here's the thing. We just said Apple, right? I mean, that just hit $1 trillion. Everybody knows it. Everybody's using it. But the thing about this, and this is why Bill Gates, when he was in court and the U.S. Was trying to say that he was running a monopoly and trying to shut him down, and the way he won that court hearing was saying, I don't have a monopoly. Any day somebody could come along with a better idea and put me out of business. And that's the truth. I mean, this technology that we're holding in our hand, that we're probably listening to this podcast on, that technology can be replaced tomorrow by another idea that's better.
No doubt.
We're seeing that. I mean, what happened to Blockbuster? Movie gallery, gone. Redbox taking them out. I mean, we've already heard all sort of different new AI that's coming out that's going to revolutionize. These insurance companies, they've been around since 1850. They've seen a thing or two, right? I mean, here's the thing. They're here to stay because there's one thing that's guaranteed in this life is death. That's right. They are insuring against that at the bottom line. And so we know that these companies are going to be around. So when you talk about safety, there's nothing that we can put our money in that these insurance companies have not seen.
Yeah, don't even start the conversation about banks being safe because we've seen those things crumble in the last 10 years at a high rate, and we will see more.
All right, let's talk about tax benefits, though. Tax advantages, because that's a big one that we're focused on. How do we keep more of the money that we make? Because that's ultimately how we get to measure what's left over. What's the tax benefits of the life insurance contract versus something else?
Well, the fact of not having to pay tax on the growth and the distribution of my money, I think I'll take that.
But here's let me give you the adage. Well, Joey, you could be putting that $50,000 a year into this SEP IRA, and you wouldn't have had to pay tax on it today.
So deferring tax, and we've actually covered this in the episode on why I cashed out my IRA and never looked back. So go back and listen to that if you want to hear more about this. But deferral is not a benefit to me. Because why? Because I am a firm believer that we are in a discounted tax rate. right now because our government will continue to spend out of control, and somebody's going to have to pay the piper. And that's not you and me talking. That's not our opinion. That's people way smarter than us, like the David Walkers of the world, who's the comptroller of the Treasury. I mean, this guy knows what he's talking about when he says taxes must double. I think I'll take my 25%, my 50% discount today.
Yeah, no, absolutely. I totally agree. It always goes back to compared to what. So when somebody's asking you these things, ask these questions: compared to what? So here's the key. Stay in community with others who are doing this. So if you're not engaged in the Wealth Council, if you're clients of ours, please get involved in this. You're going to be not only encouraged by those around you, but also you're going to find out lots of new things that you probably didn't even know. Because here's the beauty of this thing. The access and ability to this money amazes me every day when we get people calling us, asking us, hey, I need to get a loan against my insurance policy because I'm about to go do this with it.
Yeah, fill in the blank.
And it's just so awesome when we get to hear those stories of people starting businesses, people who help their grandchild just buy their first car, people who are insuring their businesses and expansions, and they're seeing enormous growth, and it's all fueled by their ability to take advantage of those things. I mean, your life, you came into this industry because of the amount of cash values you had built up and gave you the ability to transition.
There's no question I would have never left my job had I not had so much access to cash in my policies. I was able to live off of those for 2 years while I built this business from scratch, and that gave me all the confidence in the world.
Well, there's so many things that you could point back to. If you're in this situation, if you're receiving this podcast from us or from somebody else because somebody's challenging you on whether you're doing the right thing, go back and listen to our podcast that we did on how opportunities find cash. Go listen to how Joey cashed out his IRA and never looked back. Go listen to the one by Nelson Nash on the simplicity that was created in his life of doing this.
Yeah. And we haven't even gotten into so many other aspects of this. We wanted to give you a little bit of fuel today to be thinking, if I get in this position, how would I respond? We're talking about how you can continue to earn on the cash in your policy. We've already mentioned that. But what about the tax-free income? I just want to hit on that real quick before we go. What other asset could I be putting money in today that's going to create an income stream to me in the future that compares to life insurance? Just hit on that real quick.
Well, we touched on this on a previous podcast too. The traditional market investment, we can take out about a 3% withdrawal rate and over a 25, 30-year period of time without worrying about it going to zero, right? That's kind of what the current statistics show us.
Right.
And those numbers can change. The more volatile the market is, those numbers can keep going down because it was at 5% like 20 years ago, and it's now dropped to almost 3%. Well, a life insurance policy, because it has zero volatility in it, it's constantly growing, takes those numbers and almost doubles them. We're seeing 6 and 7% withdrawal rates. So almost twice what we can take out in these insurance policies later down the road as a alternative to, say, a pension or to Social Security, because we know for our age demographic, those things don't exist for us.
Yeah,
at least
no doubt.
not the way that they did for our parents and grandparents.
Yeah, a couple little things here. You said zero volatility. I want to continue to harp on that. That's a huge, huge benefit of your life insurance. And number two, the thing, make the connection. Tax-free income distributions means I'm not having to work as hard to accumulate in my policy as I would any tax-deferred asset, right?
No, you have to get $3 for every dollar in cash value to equal the same income in retirement. I've done the math so many different times. When you take into account the taxes that have to come out of it and the fact that I take out 50% of what I can take out of the life insurance policy and not run out and not go to zero. Think about the risk, the stress that's on your life to constantly sit there and look at the ticker to determine, are you going to get 3 to 1?
Oh.
And by the way, going back to what we said from the beginning, if I really believe that investment can earn 3%, 3 times 300% over my life insurance policy, why would I not take a loan against a life insurance policy and just buy that thing?
Get both, right?
Have protection. It's so crazy to me. That is a huge point. Don't ever forget that. That is not either or. It's both. It's and.
Right. We hope that today you're going to have more simplicity in the way you think about this. You're going to be a little bit more sure and clear, but that you're going to not have to start and stop all the time.
Yeah.
Right.
Yeah. We love the fact that we get to avoid starting and stopping. Because, I mean, that happens so frequently. That's exactly the reason why the average mutual fund investor gets like 2.9% over time, is because they buy at the highs and they sell at the lows. They don't get it. I mean, that whole mountain chart of, the market earning 8 to 10% over time, that may be truth, but nobody gets that because they're not in the market all throughout those time frames.
That's right.
Your mutual fund babysitter, he's getting scared. He's pulling money out of the market. You're sitting in cash. You're getting back in when the market's jumping up. Then it drops. Then he's pulling you back out. It's a never-ending cycle. So if you're sitting there contemplating, should you get rid of your life insurance policy, the starting and stopping effect is going to crush you over time. Trust your initial opinion, get in community with others, listen to this podcast, go back and listen to others, and you will know that you're doing the right thing. So thank you so much for listening to this podcast. As always, we really appreciate you, our listener.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.